Vulture Investing Risks When Things Go Wrong. Welcome back to the Art of Vulture Investing. In our last episode, we explored how vulture investors exit their investments and how they lock in profits. But not every deal has a happy ending. In this episode, we explore the other side of the coin. What happens when vulture investing goes wrong? Even smart investors can lose money. Even well-researched deals can fail. Let's take a look at the real risks of vulture investing and how professionals like George Schultze deal with them. Risk number 1. The company completely fails. Sometimes, despite all efforts, the company's business just cannot be saved. Maybe customers leave. Management is weak. New competition takes over. The market changes too fast. If the company's assets are worth less than its debts, creditors may get nothing. For vulture investors, this means a total loss on that investment. Risk number 2. Legal battles and delays. Bankruptcy court is full of legal complexity. The process often involves multiple lawsuits, competing creditor groups, challenges from employees, suppliers, or the government. This can cause long delays, sometimes for years. During this time, investor money is stuck and not earning anything. Worse, the final plan approved by the judge may give lower recovery than expected or even wipe out some investors entirely. Risk number 3. Unfair reorganization plans. In theory, bankruptcy law is supposed to be fair. But in reality, bigger players often have more power. If a large creditor or lender controls the process, they may push a plan that favors them and hurts smaller investors. Vulture investors who own junior debt or equity might get pushed down or excluded even after doing all the work. This is where knowing your legal rights becomes critical. Risk number 4. Overpaying for distressed debt. Sometimes, investors get too optimistic and pay more than they should. Let's say a distressed bond is trading at COE 500. The investor believes it will pay CO 800 after reorganization. But if the recovery turns out to be only SHE 400, the investor loses money. That's why it's important to stay realistic. Use conservative assumptions and leave room for error. Risk number 5. Emotional decisions. Emotions like greed, hope, and ego can cloud judgment. Some investors fall in love with a failing company because they've spent so much time on it. They keep holding the security even when the signs are bad. Smart vulture investors follow a strict rule. If the facts change, change your position. George Schultze talks about this in the book that emotions can kill even the best strategies. Real example, when a deal failed. George once invested in a distressed media company. It looked promising. Valuable assets, strong brand, and a potential buyer. But then, the buyer backed out. Ad revenue fell. The court rejected the reorganization plan. George had to exit with a partial loss. But because he had a risk plan in place, the damage was controlled. He moved on and used the lessons in his next deal. How pros manage risk. Here's how professional vulture investors protect themselves. Number 1. Diversify. Never put all your money in one distressed company. Spread your investments. Number 2. Buy at deep discounts. Lower entry prices mean more room for profit and less damage if things go wrong. Number 3. Understand the capital structure. Know your position. Secured debt, unsecured debt, or equity. Higher positions have more legal protection. Number 4. Study the law. Knowing bankruptcy law helps you protect your rights in court. Number 5. Exit early if needed. If a deal is going bad, exiting early with a small loss is better than losing everything. George's risk strategy. George Schultze believes in limiting downside. He once said, I don't mind missing out on the last 20% of upside, as long as I've protected the downside. That mindset helps him survive bad deals and win more in the long run. Common mistakes to avoid: buying too early, before the full picture is clear; ignoring legal details; overestimating asset value; holding too long out of hope; investing without a clear exit plan. Avoiding these mistakes separates smart vultures from gamblers. What you learned today: vulture investing has real risks: legal, financial, and emotional. Companies may collapse completely. Court decisions can be unpredictable. Overconfidence leads to bad bets. Professionals like George Schultze manage risk through planning, discipline, and strategy. Coming up next, in Episode 8, we'll explore real case studies, deals where vulture investors made massive gains, and lessons from the best plays in distressed investing. Don't forget to like, subscribe, and hit the bell icon for future episodes. Thanks for watching The Art of Vulture Investing.